There is something brewing in the bond market. The 10-year Treasury yield hitting a 4-month high. It is now up 22 basis points in just the last 23 days. And that big move could write the tale of two big trades if the trend continues. We're talking about banks as well as housing. Let's start off with the banks. XLF Financials ETF gaining nearly 2% today on the back of that big move higher in the rates. So, Karen, do you think that this... We've often made the point that it shouldn't be just rates the banks trade on, yet here we are.
Right, they do. I mean, they trade as if they're one giant 2-year, 10-year spread, and that spread is now wider than it has been in a really long time. But so the three things going on in the banks. One, I think they were too cheap, but what we focused on in earnings was net interest margin, which was clearly under pressure, loan growth, and loan loss provisions. So the loan loss wasn't nearly as bad as people feared. The net interest margin wasn't great, but this will help them, no doubt. So they should be higher. I thought they were too cheap before. As to loan growth, that's going to take a little longer. But one other thing I just want to add, last night both Discover Financial and Capital One, both after the close today, both had good earnings driven a lot by good loan loss provision, good credit quality. So that should help the banks as well.
Yeah, Bonawyn, and certainly that had been a concern. But we are still in a forbearance period for many Americans who are having some trouble. So maybe the jury's still out a little bit on that.
Yes, which is why you still see loan loss provisions at the levels that they are overall. But this is precisely why I like the large bulge bracket banks that have commercial and trading operations. You've seen it in previous quarters, the trading, the fee generation, the deal calendar, all those things have helped to buoy them through the COVID. And now what you're seeing is a 210 spread that bodes well for net interest margin, which is really their core business. So I think this is definitely a positive trend, and I would expect this to continue going forward. The one caveat is that I think a lot of what we're seeing is on the back of stimulus. So any news that comes pro or against that is going to send a few shock waves to the system. But be ready to trade these two ways.
In a rising rate environment in which the curve is actually steepening, Tim, does your view on which banks to own change at all?
Yeah, you want the ones that have more leverage or who are weaker players, and therefore they're going to benefit more by this net interest margin benefit. So this is absolutely Citibank. But I agree with all we've said here. I think the loan loss provision number, these banks were being punished for that 2 quarters ago if there was some big secret that they were hiding. I think some of what's going on with the bond market is truly a better economy. Some of it is, I think, some read on stimulus. And if you look at J.P. Morgan, there's a little bit of cherry picking here, but I think it's okay to do with banks where sentiment's been so bad. J.P. Morgan is flat to the S&P since mid-May. So say all you want. But the best bank out there has actually traded sideways to a market that most people would say, I wouldn't have mind owning that market. So the fact that it's hanging in there, to me, is through a lot of bad news, tells you it's a stock that you want to own as things get a little bit brighter. All
right, let's move on to housing here. We are seeing some weakness in the housing trade as yields creep higher. So does it put this big group at risk in terms of the trade here, Guy?
Yeah, I think it does. And, we've liked this for a while, and it's been right to like them. But you look at two names specifically. Look at Toll Brothers and Pulte Homes. And Toll Brothers, you go back to the February high, I think it was $50 or thereabouts. And obviously everything fell off a cliff from there. But go back to October 8th and look where Toll Brothers traded up to and apparently failed at. The technicians, if Carter Braxton Worth were here, he would say what a tremendous double top we have in both Toll Brothers and Pulte Homes. And I would agree. So not only does the move in interest rates concerning, but where these stocks stopped at is also concerning. So if you're long these names, you have to take a long, hard look and say, am I willing to bet against this double top and rates moving higher, or should I be taking money off the table? I think you should be taking money off the table.
Karen, how do you think about rising rates and some of the ancillary sort of home retail trades that we've been talking about? Home Depot, a Lowe's, RH, WSM?
Right. Well, they are driven by housing in that, you buy a new house and then you do all the things you want to do to it, or you fix up the current house. But I think they are also stimulus driven as well. So Lowe's and Home Depot, for example, which I own, I think that's going to be really important to them, more important in the short term than rates. And if rates stay around here, I think that trade, it's been a great trade. If you back up and look, it's only back down a little bit from the peak. A lot of great things are going on that are sort of the ballast for this trade. So I still like it, and I think with a stimulus, I think Lowe's and Home Depot will do fine.
Same question to you, Tim.
Look, existing home sales were at 14-year highs today. So I don't know what rates have gone up 20 basis points off of all-time lows, off of a gap lower. The 10-year could go to 1.25 before this should hurt the housing trade. Let's be clear. And the issue with the home builders is supply issues. And we're talking about existing home sales, the velocity of home ownership and changing hands and fixing up and lower rates and HELOC loans. That's not going to end anytime soon. And we haven't even gotten into all those secular trends that we talk about that may be going on out of the urban into the regional, you name it. But no, look, I think different than owning the home builders than it is some of these home improvement stocks or building materials. And I think those trades look very, very strong still because the valuations aren't terrible. The home builders, I don't think you need to own here. But to say that the housing market is under pressure, and I don't think you are, and I don't think Guy is, I think we're talking about sensitivities here, but I think we have a way to go on the long end before the housing market really struggles. I think this is heyday time.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.